They say we should have known better than to fall so deep down into this rabbit hole we found. And I was thinking,
hi, this is Nico. You're listening to my Dad Fall, also known as the White Rabbit, and James Jardine on the one and only Down the Security Rabbit Hole podcast. Buckle up and enjoy.
deep into this pool of regrettable situations. Pitch black, think back to the last time that we were happy.
Okay, welcome live audience as you guys all join in. Sorry about the pre-live banter there. We were trying to figure out how to get LinkedIn to work, and LinkedIn does the LinkedIn thing, which means it takes about 5 minutes to start working. So good morning, good afternoon, and good evening. Welcome down the Security Rabbit Hole to another edition of the Down the Security Rabbit Hole podcast. This is Ralph. I am super stoked about this one. I've got James, I've got Jim, and I have Patrick. Hi, everybody.
Morning.
All right, here we go.
Patrick from his overlord den up there in the
it's doing okay today, you know. Jim and I are representing the USA.
That's it, man. It's the wooden flag competition.
That's right.
We're taking votes. Live
Look at
votes
Raph
right now.
looking around. He was like, "What do I got? What do I got?"
Oh, he's got everything.
Yeah, he's got one of everything. There's a flag.
Everything but the USA. He's got a bunch like Canada up there or something.
Canada, get out of here. See, I'm secretly a Canadian. Is that what you're trying to say? I'm secretly a Canadian? No, man,
Listen,
that's not how it goes.
You can kind of see it. I got the USA on the globe back there. So
There you go.
Yeah, he's got it covered.
Nicely done, by the way. You got the index finger right on it.
Yeah.
That was pretty
It was
magic.
difficult.
He's got mirroring turned off.
It's over. It's this. All right.
I have to do the mirror turned off because then my logo and everything goes
Right.
backwards and it's no good. So
All right, let's do this. So I like having Patrick on the show because Patrick tends to Patrick, you tend to tell things the way they are, and I appreciate that about you. And you know finance really well, and you know cyber very well, and you run companies, and we've got a really weird time in the industry right now where I don't know, I'll bracket it like this by saying it used to be that you could like throw something on the back of a napkin, run it past the VC, and they throw some money at you. Then markets got kind of tight because the cost to borrow got expensive, and there's like this huge panic about companies that were running out of money. It's weird times, would you say?
Yeah, I mean, I think it's weird times for this industry. It's not weird times. If we rolled back through kind of investing history and tech history, this type of thing happens. Like there's definitely, and we can talk about it today, there's some points in this cycle that are very consistent with points in other cycles, but this is the first time this industry has gone through kind of a down part of a cycle. And so that feels weird. Does that make sense?
Yeah, because I officially kind of got into it late 90s when everybody was at a startup. People were making tons of money for absolutely no reason. And I felt like around the 07, 08, we hit a bit of a trough. And then I quickly recovered, and it was the land of milk and honey again.
Yeah. Well, I guess one thing to probably kind of like tease out early in this is, the first set of cycles, and we can kind of go through and talk about each of them if it makes sense, or at least pick on a couple.
Yeah.
If you roll back, like the first cycle in kind of tech was a computing cycle. Like it wasn't as narrow as cyber. It was right? Like computing is becoming a thing, probably followed by like the internet, followed by like mobile. Well, each one of those has gotten a bit narrower, if you will, because like some of when computing started out, I was like, oh, computing is going to change the GDP. Okay, so that was like a really broad statement, and by the way, it has. The trick now is like when you're making investments, most people are no longer making investments in that broad swath. It's more narrow band. So you're making investments in cyber. And so to some extent, you see the fragility poke through a little bit more in some of these really domain specific cycles because they're much narrower.
Okay.
And that's a distinction. I think there is an exception that is happening right now to that rule, which is AI stands to have like GDP level consequences again. I know nobody likes those words, but that's part of why you're seeing the money move around. So you got a couple things. Like you're absolutely right. Money got expensive, and we can talk about when that happened. That's really well understood. That happened when something called ZIRP ended, the zero interest rate policy. So that happened. You're right. Fact. Two, cyber as a wave was a little more narrow than some of these other big waves. And so it's been exposed a little more fragile, and then three, like the part we can probably spend a little bit of time on here is, and you all have seen this in the industry, the spending is down. So, cyber had a really good run where, just like you said, you could get funded by any VC, any CISO could get any project funded too. The fact that you're no longer seeing VCs fund at the same rate has a lot to do with the fact you're seeing CISOs get told no. So there's a consequence here that might not be obvious to people, but when CISOs start to get asked to like go back and sharpen their pencils, the venture folks and the private equity folks and everybody else goes, maybe we need to sharpen our pencils too.
I'm having a lot
Does
more.
that come about? Does that
Go
come
ahead.
about somewhat too with maturity of the industry, and that these tools have been out there for a long time? People are starting to understand. Okay, yeah, that one worked. That one didn't work. I don't need 50 tools. I can get away with 3 tools. Like seeing that history of stuff going and saying, okay, yeah, I'm slowing my spending because I don't need all that stuff. It was the world's on fire. Now it's not on fire. We start to have a better understanding of the realization around what security means for an organization.
Yeah, through the lens that we started this podcast on, investing, let me try to connect that dot. If you're an investor, you're putting money into a company because you think there's a chance they're going to take a disproportionate amount of share. Now, the dirty little secret in venture and private equity to a large degree is you expect to have a small number of winners and a long tail of losers, and you expect that one winner to look like CrowdStrike,
Right.
to pick an example, right? And so your point's right. Over time, as it matures, then the swath of people kind of narrows down a little bit, and you're like, oh, the winner is going to be CrowdStrike and Sentinel-1, and these folks are going to fall off the turnip truck. Now, I think the part that has been historically different in cyber is, but then an attacker changes the way they're going to go at a customer. Somebody invents a new thing, and then there's new propensity to buy. I think that part has stayed the same. Attackers are still coming up with new vectors, but people are putting pressure back on CISOs to say, just figure out how to deal with the new threat with your existing budget. That part's new.
Is it also tied into the fact that on a more, say, esoteric level, is that organizations are getting tired of like just this constant round of feed me money for something new, right? I mean, so you said it yourself, the threat condition isn't changing. It's still moving forward, right?
Right.
And there's probably 20 more CrowdStrikes out there that are not getting it done, because I think the consumer side, the ones that are telling the CISOs no, I think I think there's a degree of fatigue, right? Think about it from that perspective. So I think, are we dealing with a much more deeper down cycle? I mean, I like to go back to something you said earlier on, maybe when you're ready, but I'd be very interested in this cycle that you're speaking of, and what were some of the precursors that you saw, perhaps, and what are the precursors of coming out of it?
Yeah, well, let's try to deal with the cycle thing, because that might be a new conversation for this audience, right? So if you took the NASDAQ tech sector 100, okay, which is like kind of a way to look at the market, all right, there was a moment where the zero interest rate policy ran basically, let's call it January of 20, kind of ended, I don't know, like call it March of 22, sometime in that area, right? And so if you put on that, if you took the NASDAQ Tech 100 and you made a stock market chart and you put the period where ZERP was in place, you would see that the market ran while ZERP was in place, okay? And then you would see that it turned and it dipped when people started to think ZERP was going to end. And you can just like literally see it in the chart. And so that peak to trough, where we're talking about the peak of that particular NASDAQ Tech 100 to the trough, that was like in the universe of a 36% change. So it was a huge, huge change.
Huge.
Right? So think about that. If you were a public market investor in the NASDAQ Tech 100, you took a 36% ride on the downside just when they said zero interest rates were going to get caught back. Okay. So we tend to, I tend to tell people a lot that I find investing to be a staircase up and an elevator down. Okay. The elevator down moment here had a lot to do with the zero interest rate policy, and you can just see it in the chart. Now, you might say like, yeah, okay, Patrick, but that's public markets. Truth be told, like, yes, there's asymmetry between public markets and private markets, but it tends to close over time. So, Jim, you can see very, very clearly a run based upon the fact we had a zero interest rate policy and a pullback based upon us pulling back on it. Move aside all the other factors, you can just see it in the chart, right? And that affected everybody.
So
Raf, that's what got to your expensive money point, by the way.
Yeah.
It's the pullback of ZERP caused the money to get expensive.
Well, we talked about it at the time, right? Like suddenly companies that were spending money like crazy because it was cheap to go get more investment, where we're about to run out of cash, went for another round, and we're told, hey, we're $1 billion. And then investors were like, no, you're worth now half that. And by the way, it's much more expensive to get more money. And they're like, what?
Yeah. So let me put a number behind that for you guys. In that same period, I'm going to use multiples. I know this is like not necessarily down the middle of the fairway for this audience. So if I'm off the reservation, you guys tell me, we'll pull it back and we'll try to put it in more plain speak. So I'm going to use 2 multiples for everybody. Like this is an enterprise value revenue multiple, right? So basically multiplying revenue by some number to get to the value of a company, right? During ZERP, all right, so like when interest rates were zero, you could have had a company that had below 15% EBITDA margin, just call that profit to keep it easy. Okay. And if you were growing more than 25%, you would have been paid 29 times revenue for that company. Okay. So that's that's very low profit, really high growth. Okay.
Wow.
And Raf, this is getting to your like companies burning cash thing.
Yeah.
Post ZERP, that 29 multiple compressed to 8.5.
Oh crap.
So people were willing to pay almost 4 times less for a company that had a low profitability profile. Let me compare that, okay, with a lower growth, high margin company. Okay. So same periods, right? If you were growing at less than 10%, but you had 25 points of EBITDA margin, okay, they would have paid you 6x, so much less, okay, at peak, but it only compressed to 5x post ZERP. Wow. Does that make sense? So just like the relative basis of what people were willing to pay changed meaningfully. So now you're like, okay, why does that matter in cyber? I cannot tell you how many cyber companies have low or no profit with high growth rates. That's just like what they all look like.
But Patrick, that's what it's been for years. Look at Palo Alto was a perfect example of that. It took them like 20 years to finally turn a profit.
Splunk is a good example. They're a poster children of that.
I mean, so listen, you guys are all right. So the reason why I got pretty hawkish on the space, and Raf was like, dude, why are you so hawkish right now? Is because once you go through all that fancy math, it really comes down to like the risk of, do you think it's going to get better or do you think it's going to get worse? All right. And so if you were one of these folks that was invested in a cyber company that's burning cash and the zero interest rate policy went away and you don't have a path to profitability, yeah, like why would you put another dollar in that company?
You get the
You
hell
know?
out of that.
Yeah. So that's why you saw a lot of people. That's why, well, so one, the other thing that happens there, the consequence of that, and by the way, you can see this in the Carta data if anybody wants to go look at it, but like a bunch of venture capital backed companies went bankrupt during this period. So, you know, like this goes wildly underreported because private companies are private companies. But, you know, during ZERP, okay, I'll give you another fun fact. It'll be fun fact episode. You know, venture bankruptcies in a quarter were generally 50 to 60. Okay. Post ZERP, the number of venture backed bankruptcies started to average closer to 200.
Wow. So 4x.
4x.
So
Yeah.
those are crisscrossing numbers, man.
Yeah.
Your factor dropped by a factor of 4, and the bankruptcy increased by a factor of 4.
Right.
Yeah. Yeah. Because people, I mean, people just said like, hey, I can't put more money into this thing that I'm not going to get out of and you know, make a return.
Can I make what I feel like is an obvious statement that I've never understood about it? Like, I get the whole, you bet on a bunch of horses, 9 out of 10 of them will lose, one of them makes it big. That's the whole VC game, right? And I
Definitely the VC game. Yes.
And I get that. But how did we get to hundreds and hundreds of companies that weren't making money, that continued to get massive investment? Because that we should have, I don't know, like maybe I just grew up in a different time, in a different like type of mental financial headspace where like if you weren't making money, if you didn't have a short path, at least some profitability that somebody could then add a dollar and make more profitability. If you were to tell me, hey, I'm going to lose money for the next 10 years, but go ahead and invest in me, people would like I would have laughed, like, no, that's retarded. Why would I do that?
Yeah. So listen, it's funny. Almost all tech investing is growth investing. Okay. And let me give you what an alternative investment might be. If there's growth on one hand, there's value on the other. There's a bunch of other stuff, but let's oversimplify and call it growth or value. It is hard to be in value tech. And, you know, it's just, and some of that has to do with age. So this is a very growth focused investment sector. And that's one of the reasons why you see them biased toward growth. And let me make I'm going to kind of steel man the other side of this argument, even though I'm a more value person. You know, somebody did watch Tesla go do a gajillion X, and somebody that was in Uber did a gajillion X return, and somebody in Google did a gajillion X return. And so I think what people miss is, you know, the people that hit those big ones, it's just so outsized. It's not like it's 10 times bigger. It's a 10,000x return.
Yeah.
Right. And so, you know, that's one. And then two, the second part about tech that's, you know, weird is most people say, I want a really high growth rate because I want to secure that part of the market before there's other entrants. That's different than in like construction, where people are going to go build houses. There's a lot of time, like market share is not going to move overnight. You know, in tech, market share can move overnight. And so if somebody comes up with a better product, you can see a share shift happen quickly, and people don't want to be left out.
I think that's the part that I was missing, is that I wasn't factoring that whole like, hey, tomorrow you could have 10 competitors, get as much market share. But I think that could be a red herring too, Patrick, because just because you have a bunch of market share doesn't mean that those people don't switch to your competitor tomorrow.
Well, I mean, so let's pick a very real one that you all lived through, right? Like how many of us, like in some way, shape, or form, either bought or worked for an antivirus company? It's like
everyone,
right?
Right. Twice.
All right. And where did the EDR money come from? It's not new money, right? It share shifted antivirus, right? Now, that's an interesting one, because then you're taking a category and you're kind of cannibalizing the category with a new one. What's tricky in cyber is sometimes you get to a whole new categories. Like, let's pick a fun one that really hasn't gone anywhere. Like, how many companies are left in honeypotting? Right? And do you remember like 2-3 years ago when all we were talking about was that? Like, so The dynamic in cyber is a little interesting. Sometimes you're going after share shifting out of categories that have been there for a while. Sometimes you're trying to build a whole new category. Those two investments look very, very different.
Is there any rhyme or reason to the way that financial cycles outside of tech, like the way that global financial markets move, because you're trying to effectively time those markets to get cheap money while dropping a product in at the right time, right? To be an innovator. Because you don't, I imagine nobody really wants to go sell 80% stake in their company just for a small investment on a maybe, right? If they don't have you don't think you have a solid winner. I feel like this is like a Shark Tank conversation where they're like, I've got this great idea. And they're like, I'll take 50% stake in your company for $1,000. And the person's like, well, I mean, I got very few other options.
So now we're talking about company building, I think, which is a slightly different thing.
Yeah. Sorry.
Listen, the one thing
that, the tangents.
Well, no, you're not. They're all fine. Like, so the venture folks let's draw a distinction here between public markets, private equity, and venture. Okay. Let's zoom in on venture for a second. So I've worked with Lux, Icon, Google Ventures, Kleiner Perkins, and some other folks, right? Let's call that a pretty decent sample. One thing that is true about all those folks as investors is they are all willing to see an optimistic future, which makes them very different, by the way. And like, let me take the most conservative investor group in the world, debt investors. They have no optimism. Okay. And so, when you're company building and you're in venture, like, you ask crazy questions like, why is this going to change the world? Why is this going to be a new market? What would 100% market share look like if we made an electric car? And then an electric car gets funded. Or, what would happen if we had rocket ships that were reusable and, the price of going to space was reduced by a factor of 3 because you could reuse them 3 times. Those guys just think different. And that's why, like what would happen if you could search the world out of one, dialogue box? Yeah. So they're wired different. And so, when you meet a passionate founder that thinks they can change the world and, you believe in that, you'd be surprised how big the checks can get.
No, I mean, I've seen the checks. I've seen some of those and I was there. I was there for a startup that was a financial startup a while back, late 99, 2000. And the cash that was moved around even back then was patently absurd as far as like when I looked at it. I was like, oh my God, I've never even seen a check with that much zeros on it in my life. Like, that's incredible. Yeah. And to me, there was like when you make, when I look at things, I go, okay, if I'm going to make, I'm kind of from a different world, right? My parents grew up under communism, so a lot of this was brand new to me. Yeah. But like if you're going to invest, you're going to give somebody money, they have to have something in collateral to give you back, right? And a lot of these things were like there is IP that may or may not be worth anything, and a couple of pieces of computer, like
I mean. That's a real factor. Most people in tech investing know if it doesn't work out, it's like really not working out, right? So, I would say this, like if we compared people that invest in laundromats to people that invest in, startups, there's a lot more zeros in startups than there are in laundromats, right? Like, but I can also tell you, I don't know many people that invested in laundromats that, also turned out to make 10,000x returns on something. So, depends where you want to play, right?
How often does that hit, Patrick? Because there's only so many Splunks, Palos, CrowdStrikes out there, Wiz, to name a few, right? Is that model? I mean, there's a whole bunch of VC firms out there. There's a lot. The big ones we know some of the names for. How often does that roulette wheel stop at 4 black? Right. And you just go nuts and go, holy cow, we've done it.
We were doing the investor show, so you're gonna get the investor answer. You try to get 1 per fund. So,
okay.
If you think about the way they work, there's a fund and it exists for some period of time. They tend to be called vintages in our line of work. So you have a fund 5 vintage or a fund 4 vintage or fund 26. Yeah, it is probably because most of us are wine drinkers, right? Like if you got one really good one, this is in venture again. If you got one really good one in a fund, it'll carry the performance of the fund. Let's draw one other distinction though, because it matters a lot for your community. The private equity folks work an entirely different way. They can't have massive losers, and they're never going to have or rarely have massive winners. So the private equity folks, I think, get a bit of a bad rap with employees because it's private equity. And yes, there's been a whole bunch of nonsense over the years, and I'm sure everybody has seen some great examples of bad private equity things. But as it relates to cyber, private equity has been pretty good to cyber. They've invested in companies with more modest growth expectations and trying to kind of consolidate the industry with fewer winners that are wildly outsized, but also fewer losers. So, in a private equity fund, pick a vintage, you're not looking for kind of the Google outcome. You're looking for some set of reasonable outcomes where you're going to make, kind of averaging 2 to 3x your money across the portfolio. So it probably means some didn't produce a return and 1 or 2 produced a 5x, 6x kind of thing. So if you're kind of like the average, employee working for a private equity backed company is not necessarily a bad thing. They're more likely going to produce a financial outcome probably than venture. You're just trading off the upside.
That's fair.
If I may, again, trying to create a bridge between your world and cyber in many ways, but I feel like there's been a tone.
Yeah. Okay.
That
this one's going to be good. This one has a wind up. I can be like, it's coming.
No, more of like, I think there's a sense among a segment of the cybersecurity community that believes that there's products that are out there that are not living up to expectations from the consumer and professional side of the environment that lives and breathes cyber, versus maybe the entities that are behind it that are want that portfolio winning racehorse, that pony in that race, come hell or high water kind of thing.
Yeah.
Right?
Yeah.
So, and I would, how true is that from your perspective? Where would you, I know it's a really hard question for you to answer, but in the broadest sense of the term, do you see that happening?
So it's actually maybe easier than you would expect. This is the part where, like in my line of work, you can't specialize in everything. So I only really do 2 sectors. I do security software and contact center software. Listen, security's got a lot of poser software. So, and he
said it, everybody. He said it. Yeah. He just said that.
Yeah, I
didn't say it. For once, it wasn't me that said it.
For once,
there's a lot of poser software, and there's at least kind of like 2 reasons why. And Jim, I diligenced when I decided to like just go back into private equity and hang out and not be a CEO for a while. I diligenced about 500 companies in that period of time. Whew. So like if there's anybody, it's why like I'm giving you I think a fair shake on this one. Cyber's got that fast flywheel that makes cyber so cool of like, oh, there's this new attack and there's this new threat vector. Like it causes money to move faster. And so the big dreamers move faster. And all of a sudden you're like, is that really going to be a thing that's going to stick? And as a result, you see a lot of like pretty crappy MVP. So, I think where cyber got funky was take a really fast flywheel, you take a high risk situation where people are kind of spending to protect themselves from things they don't understand. And all of a sudden it becomes very low risk to like start a company and throw some software out there. Especially when so few outcomes come from these products, right? Like My favorite one is the one that are like stop breaches. I'm like, oh, really? We stop breaches, huh? Like, really? Did that start? Did I miss the part where they stopped? Like, so yeah, there's a lot of poser software out there, and it's difficult for an investor to discern that without seeing some in-market performance. And I guess I'll be civil and save names on that, but we could go back and I think probably all make a long list of those companies.
Is that because too there's not a lot of risk, right? I mean, I can go out and create something and sell it to anybody and say it does whatever, but what's the risk to the seller of that stuff? So getting into the market and say, oh, I've got a new SaaS tool, here you go. And okay, it didn't find anything. Well, we said it, we didn't guarantee it would find everything.
That's right.
Right? Like there is no liability sitting there that if your tool doesn't work, it does,
let me compare and contrast something. Okay. So like in contact center, if you've ever received a phone call from a contact center, that's outbound contact, that's managed in the United States by something called the TCPA regulations, which means you actually have to have somebody on the end of that phone if you pick up within a very small number of seconds, or there's a fine. The number of people that make outbound dialing software right now is 3. Okay. And part of it is for the point James just made. If you screw the software up, somebody's getting fined. And if they get fined, they're coming back to you and saying like, hey, why aren't you liable for this fine that I have? Right. In cyber, we got very comfortable with shitty software. We did. And there was pretty low risk to it going out unless there were people running around with American flags. And, yeah, it was unfortunate. And I'll tell you when I think it happened. It happened when it became an industry where it used to be primarily law enforcement, military folks, intel folks, and vets. And then we had to kind of sweep because we needed to scale up and all the IT folks came. You wound up with this like, oh, we're writing IT software, which is different than writing security software. And you kind of see a different performance curve.
Well, and it became acceptable for the fact that everybody just understood. I'm getting this tool, it's going to help, but you remember, we never know all the unknowns. So we know what it tells us, we don't know what it didn't tell us, and we're okay with that. So if it didn't tell us something, all right, but that was just a limitation of the tool.
This kind of goes back to like to circle this back a little bit, right? We talk about value creation, and both on the investor side, and then like if I'm buying something, what value? So I'm having as a vendor, I'm having a ton of conversations, and I can tell very quickly which CISO, if I'm talking to, has actual executive presence and board level visibility and which ones don't, because we with those that do, I'm having value conversations. If I spend, I'll give you a round number, $200,000 on thing you're selling, am I getting $200,000 worth of value, and can you show me that? Yeah, right. Those conversations are new, Patrick. Those haven't been all around. That's a new thing.
Yeah. So here's what's going on in your universe. That if you guys want to ungunk the industry, the superheroes that you are, you're going to have to help CISOs have return on investment conversations. They haven't had to do it before. Many of them come from law enforcement agency vet backgrounds. Like, they're not necessarily business people. And by the way, that's great because they actually need to know how to do their job. So I'm not suggesting we should change those people at all, but we got to teach them a new trick because they haven't had to learn this trick before. You go ask any app software VP, like, hey, what was it like to get your Workday sponsor, or pick some other thing? They'd be like, I had to write some return on investment thing, and I had to go make a presentation about it, and blah, 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 blah. CISO's never had to do any of that. It's all new. So you got to arm them and equip them to have those conversations, because there's some other dorky guy like me on the other side going like, hey man, I'd rather take the 200 grand and put it into something that's going to get me revenue. Right. And by the way, that is my job. So I'm doing my job by asking that question. So yeah, I think to ungunk the industry a little bit, we're not going to solve the crappy software problem. But what we can do is we can better equip CISOs. And then I'll touch the third rail. You guys didn't ask this one, but you get this one for free since I'm not going to be probably back for a little while.
This is the reason I brought you on.
Yeah. You know, the other thing that happened was we just decided anything could be security software. We were like, oh, it's like ITSM. Well, it's security now, right? And so, the other thing that happened was we let everybody in the club. They don't even do security stuff.
Yeah.
They do IT stuff. Kick them out of the club. You got to get back to like, if you want a little more efficacy around the software, the other thing you have to do is kind of draw a tighter perimeter on, what meets the threshold, I would say.
All right. So since you're going third rail, I'm going to do this too, because this is something you and I have had a conversation about. I've said it a couple times, but Patrick, how much are the freaking analyst firms to blame for some of this nonsense? Because I would say quite a bit.
Yeah. So you glad I'm employed. Might not be tomorrow. I mean, so they serve two purposes, right? And one of them is, well, I'm not sure either are necessary, but whatever. If somebody needs some third-party validation on a decision, you need to go to an analyst, right? Like, okay, fine, right? Where I think we get in trouble, and yeah, I'm just naming names, I don't care, specifically with places like Gartner, you can't let an analyst firm set your product strategy. And because we created a strong link between analyst firms and investors, because they now are a different pocket of dollars for these analyst dudes, right? Analyst dudes go and target investor people as a population to educate about these things. Well, then all of a sudden the nasty loop that starts is you're like some CEO or some corp dev person. You're like, okay, if I want my company to be worth more, I need to move into the Acme quadrant, right? In the upper right. Dude, none of those quadrants have ever really worked. They all change, which is like the magic of the quadrant. It isn't the magic quadrant. It's the magic of the quadrant. Like, they change when it's convenient because you need a new dollar from a subscriber.
That's right.
So like, I think the nasty loop is analysts create new quadrants. Okay. People move new products into those quadrants. People invest in the quadrants because they think that that's where buyer behavior is going to center. It happens way less frequently than people realize. So yeah, they play a role there. I mean, we would be better off if they all went to zero, or you went to the ones with high efficacy. So like shout out to Ed Amoroso, who started one after he was the CISO at AT&T, right? Yeah. Those guys do amazing work. It's bottom up. He cares about the business. He cares about the industry. Ed does legitimate analyst work. All right. We could do with more Eds, like, and fewer Gartners, but kind of is what it is.
Yeah, it feels like a tail wagging the dog at that point, right? Because the buyer goes to, the power center turns from the buyer, which is supposed to be what drives the market. If I need something, companies are supposed to develop around that to sell me the need. Well, I don't know that I need something until the analyst tells me, boy, you should be doing this. And by the way, they've already told the investors, like, hey, you should be building this because I'm about to tell people they're going to need this. And it shifted the power center, and I think it makes everything worse because we've defined, like, I'll give you an example. I won't name the company, but let's just say they were UEBA product 7-8 years ago.
Right.
4 years later, they're an XDR product. Now they're an AI something or other. And I'm like, It's literally the same product. What the hell?
That's my point around letting anybody in the club.
Yeah.
Right. And listen, the last thing I'll say about this analyst thing, because we went there, so we might as well just like take it straight to ground and like totally bury ourselves. No quadrant has been written by those people authentically. Some other company strategist came up with a market, built a product in it, and then some analyst person was like, oh, wait, now we can make that into a quadrant. There is zero original thinking there.
And then who's pushing, though, the requirement to use the quadrant? Because it's not necessarily the CISO or anything like that, right? Now you're starting to get more into like regulatory or, oh, hey, are you using something in the top
procurement people,
quadrant, right? Like, I mean,
procurement people, governance structures. It's a necessary part of what we do. It's just, I think it has some, in my universe, we call that has some perverse consequences. It's not going away. right? So you got to play the game. You just got to kind of know that it's a game. If you're in your line of work, you got to at least know it's a game. Yeah.
So
good job, Raf. Why don't we just jump right on that grenade? Appreciate that.
Listen,
Thank you.
if anybody needs to go do that, I'll take that one, because I've been in the room where, and for ethical reasons, I won't name the company or the person, where we were giving a pitch to somebody, to an analyst, who then said, "Yeah, that's okay, but I think you could be higher in this graph," we'll say.
Yeah.
And we're like, "Well, how?" Like, "Well, if you had spent more time with our consulting team to help you with that, you could get hired." I'm like, "Wait, hold on."
Right.
That doesn't seem right to me. I don't know. That makes me crazy.
I think that's right.
Yeah. So, all right.
Hey,
So now
one thing. Let me clean up one thing. The other truth about this is there are some wonderful people that work in those jobs that are great people that just happen to work in a line of work that I don't necessarily agree with. There's some cool people in there. I would encourage the cool people to get to a better place.
Hey, we hired one of them.
Yeah. Actually, you guys
He
hired
was
one.
awesome. We're like,
And
all right,
he's
you can
amazing.
work for us
Yeah.
now.
Yeah, he's amazing, right? Like, that's a great example. Yeah, you don't want to be in that spot for a long time.
So let me ask you something. When it comes to those of us that work on the vendor side, right, where I made this switch to the dark side a long while back. I like it on this side of the fence. I think it's exciting, but there's always that air of, is this like, are we in a new things come? Are we in a kind of things status quo, or are we in a consolidate? Like, I feel like right now we're in a consolidation phase where the market's sort of collapsing a little bit. I personally thought it would collapse a whole lot harder than it has, because there's still a lot of Walking Dead companies out there.
Yeah.
But how do you not put yourself into a position? Maybe there's no answer to this, but how do you not put yourself in a position where, like, hey, this is going to be the magical thing. Oh crap, I don't have a job tomorrow. Right? Like, what are the things you look out for, Patrick, as somebody that's if somebody's job searching or working at a company out there, like, how do you protect yourself as an employee from these bad ideas that just happen to get funded by accident?
Well, let's start with the obvious one, and then we'll work to the less obvious ones. First one is, if you're qualified for one of those jobs, I would never work for a company where I don't feel like I like the product. Okay. So kind of first pass filter for me is, do I believe in this product? Right. And, in my career, if you look at places I've worked, I've always said, like, I really like the product. Right.
Yeah.
The second thing is the part where I guess I would just encourage this audience to keep an open mind, because I know this word takes a lot of heat. Like, profitability is not bad. Okay. Like, I'm not sure where in history we kind of turned profit into a bad thing, but these things aren't like, they're not charities. So, understanding just enough of the financials, you have to be like some wicked finance person. You just have to know, like, are we burning cash or not? If you're burning cash, it's more risky. If you're not, it's less risky. Okay. So do I like the product? Am I burning cash? Right. The number 3 one gets a little more esoteric, but I think it's a good one, and it's one that I use. So I think it scales up and it scales down. Like, go find a CISO or somebody that uses the product and ask them the value question before you take the job. Like, hey, right? Like, CISO at Acme Corp, you're a customer, or CISO at Beta Corp, you picked another product in the category. Did you consider this one? Like, you don't need a lot of that. 2-3 conversations with somebody you trust, and then the last one is probably the hardest one, which is like, do you think that the particular category is going to be durable? And, that's another risk adjustment. If you think it's going to be durable, low risk. If you think that it's maybe a little less durable, or it's, new, more risk. And then I guess I'll give you just kind of like one universal one for right now, Raf, or I wouldn't be looking out for your crew. the companies that went through a deal, whether it's a venture deal or a private equity deal over the last kind of, during the ZERP phase, those are going to be hard ones to have an equity outcome that's going to make any money. So, if the company was acquired somewhere between, we'll just call it 2020 and middle of 2022, you should be skeptical if there's equity value. And by the way, you could pass all those other marks that I just gave you, and you'd still be kind of like in whammy zone because of the time that company did its deal.
Interesting.
I don't know if that helps.
No, I think that's a great checklist. I think that's because there's a lot of people that are looking for. There's people that are looking for meaningful work, and then there's those people that are trying to like find the winner to like exit this merry-go-round, right? And that's a hard game to play. I've tried a few times and been unsuccessful, but it's difficult because then you're more likely to take a risky bet, I think, right? And if you're taking a risky bet, you know what you're getting into.
That's what happens a lot in cyber, right?
Yeah.
If you want one more that's really cyber specific, I'm going to give you this advice, and then people are going to write you and tell you they don't know how to take it. So just warning everybody, this is like a 401 comment. All right. If you can predict a market consolidating, all right, like I'll just use an example. I thought identity would consolidate both machine and person. All right. Was pretty right on that one. If you can call those, then you dial up your exit aspects, right? Or propensity to exit. It's just, that's hard to do. I'll connect a point. It's hard to do that without just listening to those same analyst people we just talked about. And I would just tell you, like, if they were tech analysts, they didn't make it as financial analysts. Like, so the smartest minds aren't writing those charts, right? So if you can figure out as it relates to investing, right? So that last one is hard advice to take. I guess if I had to like try to tell somebody how to do it, would be like, read a lot about it and see if you see some natural overlap that creates customer benefit. That would probably be the handbook for identifying the places where consolidation happens first. Look for overlap where you can drive a different customer outcome. That's probably hard advice to make practical.
It's such an art form, Patrick. That's because I think the closer you are to the market as a technologist or a person who's focused on that as a profession, you can't separate some of your experiences and passion from it, right? And and that's where, like to Raf's point, you make a few bets, you're like, oh well, that threw the dart in the wrong target on that one, because you just you kind of, like, to your point earlier, step number one, do you believe in the product? And sometimes you make this emotional attachment to the product and the people and what you can do. You're like, this is going to solve world hunger, and no.
The talk to your friends one and talk to some CISOs, it's a step not a lot of people take. It's worth it. I mean, just like look at these conversations we've all had over time. Like, I get a lot out of these, when we do these things. It's different people's points of view, right? It's so funny that most people don't do that when they're taking a gig.
Amazing.
Yeah.
It is honestly amazing advice. And I think I can sit here and tell you that I may have done that by accident, just through organics, but as a strategy, that's a different animal altogether. And I think you're absolutely spot on. I think take some ownership in how you perceive your next step in that way by understanding it better.
Yeah. Hey, since we're this far into it, rattle that crystal ball of yours, Patrick, and tell me what you think the next, like, how long is this going to be a barren wasteland of Walking Dead in cyber? Because this doesn't look good for a while, right? I mean, you didn't walk out of this because it was fruitful.
I think that I'm going to give you my answer, and then I'm going to give you one X factor that could, might make me wrong, right? And absolutely, I'm predicting this is not investment advice, right? I just look at like,
Oh my
Oh,
goodness. Are you kidding
It
me?
dropped.
That did not just happen.
Listen, I
He'll come
told
back.
you. He made those comments. Somebody's got enough pull in the networking world to shut him down.
Oh man, I'm wait. No, he's gonna come right back. I know.
Oh no, we're waiting. It's
We're
like
waiting.
and
There's
the
no.
and the murderer is
Ironically, I think not in my view, but in other people's view, because I had somebody send me a screenshot. He's in the upper right
There he is.
magic
Man.
quadrant. So
Okay,
you
there
asked
he
the
is.
hard
All right.
question. You asked the hard question, and Boomcaster decided it was like gonna
Oh yeah.
put a tripod
Nope.
on it, right?
Ain't gonna happen.
So here's the deal. Nobody's going to want to take the medicine of the hard hits. Okay. So they're going to kind of string them out. There's probably 4 bad vintages from investing. They're going to hold those for 3 or 4 years. So it'll take 10 full years for it to unwind.
Holy smokes.
Maybe a couple more than that. Most of it, so the smartest stuff will unwind first. So like most of you won't see all that. That'll be like those companies that have been in tech for like 20 years that you forgot about, and then someday somebody brings them up and you're like, oh yeah, those guys are still around. They'll be on the tail of that 10 years. Here's the factor that'll happen. People need to get their money out of this to put it back into AI, whether we think that's a good idea or not. That's what's happening. All right. You can basically see the investment in AI as a trade-off from cyber. Like you can just see it, right? So I think inclusive of this year, it's 3 years, the first part of it. Then there's going to kind of be a middle 3, and then there'll be the tail. So
Okay.
If I were taking a job today, I would be more bullish on a company that did their last equity deal after ZERP or well in advance of ZERP. I would just be careful of the companies that did financing rounds during ZERP.
Okay.
We're all going through the list of those companies right
Yeah,
now.
we're all mentally processing right now.
Unfortunately, a very long list.
Yeah, a very, very long list.
Oh, and one other, be wary of the pivot to AI. Any of these companies that strap their name to AI are doing the same thing that I just talked about when we rounded them into security.
Mhm.
They are trying to round themselves into AI.
And the thing is, though, is it takes more than Googling it or using ChatGPT to figure out which ones are doing that, right? And there was a time I called it you want security with your fries kind of thing. And that happened with security in the early days. Okay.
Yep.
All of a sudden routers were your security router. Now we've got zero trust firewalls. I mean, it's just ludicrous. So the real message here is you need to really do your homework. Is somebody really engaging in AI and making a difference? Or is it, do you want AI with your fries kind of thing? You know what I mean? And there's a whole ladder. Sorry, what's that?
Are they building the 19th Copilot? Right.
We don't have enough time for this rabbit hole today.
We're going to come back and do another one with you, Patrick. I think we're going to have you on like as a maybe at least a quarterly, like, hey, which way's the wind blowing conversation. But you know what I gathered out of this last thing you just said? So because money that was going to cyber is now going to AI, just like money that was going to IT went to cyber. And so this is now chasing the which way the wind's blowing, which makes me think cyber, this is going to sound awful, was a fad in investing for a while. Like it was the cool thing for a bit, and now we're done.
The dirty little secret is they're all fads.
And they all come back, Raph. I mean, look, we went from boom boxes on your shoulder to tiny little earbuds, and we're 2 years away from boom boxes on your shoulder again. Like it cycles.
Yeah,
So
it'll find its equilibrium. It was just riding high.
Yeah.
Don't freak out, buddy. It's gonna be okay.
The good news is I don't think I have never thought of, because of my background, I've never thought of like the next big hypey thing is a thing to go chase. because I see it all as all of it has an expiration date, and all of it has, if somebody's investing it, there's got to be some base level of need in the market, but it's usually like 100x, overvalued, and then it like comes back to, as you say, it'll equalize and come back down to earth. We'll figure out what the actual necessary investment in cyber is, because I still don't think on the buyer side we know what that number is. Like, hey, how much should we be spending? How much should the average company be spending? How much, if you ask a CISO, what should your budget look like in proportion to IT, in proportion to company revenue and profit? We don't have a good sense of that yet.
I'll leave you with this one bombshell, because I know we're going to have to wrap up it here at some stage. That could be why Nikesh turned it all into funny money. And now you just use your funny money credits over there at Palo to buy the different stuff. Because if you're using funny money Palo credits, you don't actually have to know real value attribution. Maybe.
Yikes.
It's like miles on airlines, man.
I mean that.
Just leave you with that one.
I think. All right. I think that's what we're gonna. I have an interesting one, because I had a question asked earlier when we were talking about products. I didn't see it until just a second ago. Kareem's asked, what truly defines a better product, and how much of this is echo chamber? And then Gartner, Love, and Investors Boys Club pump and dump. Well, so we got the answer to the last part.
Yeah.
But how do you, if you're an investor, how do you define, like, hey, which one's better than the other?
It's not necessarily like, we don't stack rank them like number 1, number 2, number 3. You kind of draw this dividing line at, will the customer pay you for what that product does at a reasonable rate? And that you can test through customer interviews. So believe it or not, if you're like diligencing a company, you grab the product, you call the channel partners, you call customers, you do a bunch of interviews. And so believe it or not, like, that's how most of that gets done, is actually through customer interviews, channel partner interviews, ex-employees. And, you can drive to do 1,000 of those interviews during a diligence process, because
oh man, he's gone again. He's back.
Yeah, sorry about that. This thing, man, I'm telling you, this hot take episode is really pushing the network to drop packets. So you can do 1,000 of those interviews, believe it or not, for not a ton of money, and they'll give you a pretty good insight.
Okay. Well, that was a good place to end. Patrick, thank you so much for spending some time with us. Folks that were listening live, we had nearly 20 of you that were in there. Thanks for listening. I hope everybody enjoyed it. We'll post this in a bit. Patrick, if you have the opportunity, we'd love to have you on a semi-regular cadence to talk markets with us, because I think this is part of the education of folks in cyber that want to go into, like, seeing the bigger picture. Because I know I spent the first more than half of my career like down here staring at a keyboard going, I'm saving the world, when in reality the stuff out here was really kind of the, can either massively minimize or maximize the effort you're putting in. And I think this is a sort of a painfully necessary piece of education that I think we need.
All right. Well, as much medicine as you guys want, you let me know. All right.
Just a little bit.
Yeah.
But maybe next time we do it in the afternoon so we can drink while while doing this.
Yeah.
Thank you, Patrick.
It was good to see
Thanks, you guys.
All right.
All right, folks, thanks for listening. This has been another Down to Security Rabbit Hole podcast. I hope you enjoyed it. And check out the video if you haven't. If you didn't listen live, if you did, maybe come back and see it. There's a bunch of nuggets in here that I think are super worthwhile. We will do this again. Check out our YouTube channel, our LinkedIn page, and like and subscribe. As the kids say, share it with your friends. This is a good one. We'll talk to you guys later. Bye-bye.